To properly understand debits and credits, I think it's important to make a couple of points clear so we can remove any misconceptions. Debits and credits are neither good nor bad. Debits and credits are not the same as adding or subtracting. Debits and credits are words used to reflect the duality or double-sided nature of all financial transactions. For money to go to one account, it has to come out from another. Accountants consider every transaction to involve a flow of economic benefit from a source to a destination. Economic benefit is the potential for an asset to contribute either directly or indirectly to the flow of an entity's cash. I was saying that accountants consider every transaction to involve a flow of economic benefit from a source to a destination. Well, credits represent the source and debits represent the destination. Destinations that economic benefit can flow to include assets like cash, buildings, and amounts owed to you by others, but also expenses where a business pays a third party for a good or service they have provided, and dividends where a business distributes some of its cash to its owners. On the other hand, sources that economic benefit can flow from include owner's equity, where a business's owners give their cash to the business, liabilities such as amounts owed to a bank in exchange for a loan, or to suppliers for providing a good or service, and revenue. So let's bring back up that accounting equation that we discussed in the previous video, and I'll prove this to you. Assets equal liabilities plus equity. Now we know that assets are represented by debits and liabilities by credits. However, equity is a tricky one. To understand it properly, we have to expand it into the components that make it up. Equity equals owner's equity paid in less dividends paid out plus retained earnings. I said in the previous video that we can think of retained earnings as profit held for future use. Well, profit is made up of revenue less expenses. So let's replace retained earnings in our accounting equation with revenue less expenses. We have equity equals owner's equity paid in less dividends plus revenue less expenses. And now let's take this definition of equity and break it out in our accounting equation. Assets equal liabilities plus owner's equity paid in less dividends plus revenue less expenses. And finally, let's do a little rearrangement. So we have dividends plus expenses plus assets equal liabilities plus owner's equity paid in plus revenue. The left-hand side represents debits. These increase when debited and decrease when credited. The right-hand side is the opposite. These are credits. These increase when credited and decrease when debited. Now, I mentioned at the start of the video that I have a tip for you to remember all this. Here it is. Dealer. D-E-A-L-E-R. Dealer. If you are ever in doubt which side of the accounting equation these terms sit on, then you only have to remember this one word. Dealer.